Hi friends, this is Arnaud De Lapierre. Today we're going to talk about a concept that's particularly important to me. Trend trading. Why this topic? Because understanding the general direction of an asset can make all the difference in trade success. Whether we're in a bullish or bearish market, the trend is often the cornerstone on which experienced traders rely. By identifying these movements and adjusting our positions accordingly, we can improve our timing and profitability. So sit back comfortably and we'll explore together how to take advantage of the big market waves. Before we start, let's quickly remind ourselves what the concept of trend means. An upward trend indicates a series of increasingly higher peaks and troughs, while a downward trend shows descending peaks and troughs. One can also encounter a lateral trend when the price fluctuates within a rather narrow range. To identify these patterns, many traders use technical analysis, moving averages, support, resistance, trend channels. These tools are used to identify, I would say, the major market trends. Arming oneself with a few well-chosen indicators can certainly help to better grasp the current wave's direction. Understanding the trend is not limited to looking at a chart. It also involves connecting different elements like the economic situation, major news, or the overall sentiment of the participants. All this information combined with technical analysis strengthens the ability to detect reversal or continuation signals. Statistics and indicators do not always speak for themselves. A minimum of context must be integrated to avoid common pitfalls. Generally, a market can be influenced by an economic or macroeconomic announcement or by sudden fluctuations in sector indices. By staying responsive and informed, one anticipates changes in direction better. A quick aside to talk about an application I particularly appreciate in my daily life as a trader, and that can be very helpful to you. It's called Notrade. Available for free on iOS and Android, it stands out for its ease of use and the efficiency of the signals. It sends you alerts on stocks, cryptocurrencies, or indices based on rather sophisticated algorithms and managed by AI. The idea is to save you time while providing, I would say, reliable information to confirm your own analysis. If you're looking for a clever tool to optimize your trading routine, this application might just surprise you. Let's get back to our sheep. In trend monitoring, we often look for entry points when the price bounces off a support area or when the moving average turns upward or downward, depending on the chosen direction. The analysis of Japanese candlesticks can also provide advanced signals. A doji or a hammer near support in an uptrend generally attracts attention. Many traders like to couple these visual markers with an indicator like the relative strength index to validate the strength of the movement. The idea remains the same, to catch the wave at the right moment without missing the train. Sometimes the trend weakens or shows signs of reversal. A peak lower than the previous one, a trend line that breaks, or a technical indicator showing a divergence are frequent alerts. When these signals are spotted, it's important to act quickly, either by reducing one's position or by preparing for a potential strategy reversal. To confirm a change of direction, one can observe the closing of the daily candle if the break is clear and confirmed over several sessions. We are then probably facing a lasting market shift. When trying to take advantage of a trend, one must also consider the risks associated with sudden changes. A well-placed stop loss acts as a shield by protecting one's capital when the anticipated scenario does not materialize. Some choose a trailing stop that rises as the price advances, thus locking in a part of the gains. Risk management concerns the size of the position. It's better to avoid overexposing oneself on a single trade. A balanced portfolio helps to cushion these shocks and navigate periods of volatility without panic. The choice of time frame is often also neglected, even though it greatly influences the perception of a trend. On a 1-hour chart, one can see a positive direction, while on the daily chart, the momentum might still be neutral. To avoid mistakes, it is better to analyze multiple time frames simultaneously. This way, you can detect if the long-term trend is in harmony with the short-term one. Term. This so-called top-down approach helps confirm a scenario or avoid going against the flow. Remember that there is no right or wrong time frame. Everything depends on your style. Behind a winning or losing trade, there is capital management, which remains one of the pillars of sustainability in the stock market. Even if a trend seems clear, you never put all your eggs in the same basket. Spreading your funds over several assets avoids betting everything on one horse. Some like to adjust the size of their position according to the volatility. The more unstable the asset, the more the stake is reduced to maintain a reasonable level of risk. Finally, not being afraid of idle liquidity can sometimes prevent disappointments if a sudden reversal occurs, of course. To follow the momentum of an asset, many also rely on technical indicators like moving averages that smooth out fluctuations and allow visualizing an overall trajectory. The MACD, for its part, highlights the crossings between signal lines and can indicate acceleration or deceleration. The ADX is also popular since it measures the strength of the progression, whether bearish or bullish. By combining these indicators, one gains a sharper view of the current trend. This prevents hasty interpretations and reinforces confidence when deciding to take a position while staying alert to potential signals. Contrary, psychology, of course, also plays a major role in monitoring trends. The market can evoke strong emotions, especially when prices are volatile. It is therefore necessary to discipline oneself to a certain discipline, let's say, sticking to one's plan, accepting one's stops, avoiding overreactions, and not attempting impulsive revenge trades. Many experienced traders emphasize the importance of patience. Letting winning positions run sometimes requires ignoring some intermediate fluctuations. The goal is to keep a cool head even if the volatility seems exhilarating or even stressful. It is often discipline that makes the difference in the long term. Even though technical analysis is at the heart of trend trading, let's agree on that. The fundamental dimension provides complementary insight. Company results, interest rates, or microeconomic indicators can support or slow down an existing trend. Knowing the economic calendar allows for anticipating sharper movements, for example, during GDP announcements or central bank decisions. Similarly, a sector in particular can be driven by growth prospects, reinforcing technical signals. Thus, combining these two approaches enhances decision-making quality and reduces the risk of completely misunderstanding the trend. Exploiting a trend does not just mean buying when it is upward. When the price begins a series of increasingly lower highs and the indicators confirm a negative trend, short selling can be profitable. Short selling. Of course, this practice should not be taken lightly and requires excellent risk management, but it opens the door to opportunities even in a downturn. The important thing is to stay consistent with the overall direction and to check that volumes support the movement. If everything aligns, a targeted short can be as fruitful as a long. Sometimes we confuse a temporary correction with an authentic trend reversal, rushing to exit a position or conversely, persisting when the signs of weakening are clear is one of the common pitfalls. Another trap, wanting to systematically anticipate the end of a trend while each concrete signal has occurred. In that case, the temptation to guess the high point or low point can cause you to miss an interesting part of the movement. Finally, overanalysis. Finding a balance, a proper balance between vigilance and letting things go a little bit. Thank you for watching this video until the end. Trend trading requires a good deal of knowledge and discipline. But it can offer very good opportunities in the markets. Keep in mind that everything relies on a clever mix of analysis, patience, and risk management. I hope this sharing of experience will be useful for your future trades. Feel free to subscribe to the channel if you haven't already, and like this video to support my work. See you soon for new trading adventures. Always in a good mood.